Hello friends, I'm going to speak today about one of my most favorite asset classes, arbitrage schemes. These have been in existence since 2004 and they were called equity and derivative funds in those days. To start with, they used to be 50% in debt and 50% in arbitrage with a debt taxation. Many may not be aware of this, but yes, it is a fact that they used to be treated as debt schemes and there was a debt taxation attached to that. Subsequently, maybe a year or two down the line, it became 80-20 in favor of arbitrage and gave that equity taxation which we are currently enjoying. I'm going to speak about one of these funds, schemes with BNP Paribas Enhanced Arbitrage Fund today, which has some unique features and which is capable and has been beating the peers by a big margin through some of these strategies which they have adopted within that particular asset class, which is the arbitrage scheme. Let me first run you through in simple layman's terms what is arbitrage, how does that benefit the investors, and how can that be positioned so that we understand where does this arbitrage fund fit into our investor portfolios. Understanding ABC of arbitrage schemes. Arbitrage is nothing but buy and sell, that is lending which is secured with no price risk. That means they are 100% hedged positions with no market directional call. So the investor, the way the returns are generated is somebody buys spot and sells future of the same stock and captures that arbitrage, or what we call cost of carry, into the portfolio. So you may buy spot at 100 rupee one particular scrip and sell the future of the same scrip at 101. That 1 rupee will give you that 1% return, which is 12% per annum. So depending on what kind of an arbitrage you capture, the differential between the spot and the future prices, the returns of that particular scheme will vary. So it can be 0.5%, it can be 0.75%, it can be 1% depending on the markets. Investor investing in future markets through the mutual fund route exchanges transfer transactions from the participating brokers to the custodians, and hence it becomes a safer way of investing in this arbitrage space, which was hitherto not available so far till the mutual funds stepped in. Advantages of investing in arbitrage schemes: post-tax returns are higher than debt schemes. Arbitrage schemes, because they are 80% in arbitrage and 20% in debt, enjoy the benefit of equity taxation. That means short-term gains tax is 15%, dividend distribution tax is 0, and long-term gains tax is nil. Counterparties are custodians, which are large banks and not brokers, thereby reducing credit risk to almost nil. That means there is no credit issue as far as arbitrage schemes are concerned. So unlike defaults in the corporate debt, etc., where there is a credit issue, in the arbitrage space, because the custodians are large banks, practically it becomes more like a risk-free investment avenue for the investors. In debt schemes, investors run risk of corporate defaults, as I just explained to you. Through this route, the risk is on the exchange, more like a sovereign risk. Ideal for investment with less than 3-year investment horizon for better tax efficiency. As I explained to you, they enjoy the benefit of equity taxation. So any funds or any investments which you want to do in the debt space with less than 3 years in investment horizon, ideal way should be that you should invest in arbitrage schemes, which will be better tax efficient way of investing your money. Invest post-dividend with dividend reinvest option. Post-dividend, invest in this particular scheme with dividend reinvest option and exit post-dividends to avoid even that 15% short-term gains tax. So if you want to exit within 1 year, the ideal way for anybody to invest is invest in the dividend reinvest option on a post-tax, post-dividend payout basis on that particular day when the NAV is post-dividend, and then disinvest also, as in when you need to redeem, even again on the post-dividend declaration date. So that means there will be no short-term gains tax also, and you will avoid paying that 15% short-term gains also. So if you remain in a growth option in arbitrage schemes, and if you exit within 1 year, naturally you will end up paying 15% short-term gains tax. So if you want to avoid that, this is the best way of investing in this particular asset class. And use this effectively in asset allocation strategies. When you are actually using asset allocation strategies in your portfolios and investing in liquid fund and equity fund and doing rebalancing based on the market fundamentals, you can replace liquid fund with arbitrage schemes and do the same asset allocation strategies. In liquid funds, you will end up paying 30% short-term gains tax, or in the dividend distribution tax of 28% plus. In the arbitrage schemes, you will end up paying 15% short-term gains tax and zero dividend distribution tax if you are into that dividend option and then transferring dividend from arbitrage funds to equity funds. So this is the best way of replacing debt product with arbitrage in asset allocation strategies. So these are how you position this particular asset class and these schemes so that you can get maximum benefit out of it for your investors. Advantages of investing in arbitrage schemes, as you can see from this table, assuming a 8% return in both arbitrage as well as in the liquid fund space, earning a taxable amount of 8,000 rupees. In arbitrage schemes, there is 0% tax. In the liquid fund, you will end up paying 33% plus on short-term gains tax, or if you are in the dividend option, 28% plus in the dividend distribution tax. Post-tax basis, the same returns in arbitrage scheme is 8% versus 5.2% in the liquid fund space or any of the debt products. It can be in accrual, it can be income fund, it can be duration, etc. This is a 3-month rolling return analysis once again, where the BNP Paribas Enhanced Arbitrage Fund, the average return has been 6.2%, 3-month rolling, daily rolling averages. The CRISIL Liquid Fund Index is 6.57% on a pre-tax basis and the peer average of 5.53%. The way you should look at these numbers is that 6.2% is a post-tax return, 6.57% is a pre-tax return from which you will reduce 33%, which will be short-term gains tax. So there is no comparison between a pure debt product versus an arbitrage scheme over the shorter periods of time. Because here I'm assuming that you're in the dividend reinvestment option and naturally you will end up paying no DDT also. Otherwise, if you are in the growth option, naturally that 6.2%, there will be a tax, short-term gains tax of 15% also. But the assumption is that you will be in the dividend reinvestment option, as I've explained to you earlier, and that will take away the burden of short-term gains tax also. So 6.2% post-tax versus 6.57% pre-tax return, a huge difference. If you see the 6-month daily rolling returns again, BNP Paribas Enhanced Arbitrage Fund has delivered 6.25%. Post-tax, CRISIL Liquid Fund Index 6.65% again, and the peer average of 5.61%. Clearly the winner is BNP Paribas Enhanced Arbitrage Fund once again. I hope you've understood the importance of this particular scheme and the asset class in your investor portfolios. First and foremost, any investments which is less than 3 years in the debt space, ideally you should be allocating that money to the arbitrage schemes, and specifically BNP Paribas Enhanced Arbitrage Fund, which has been delivering extra alpha over their peers in the same group. Use it for asset allocation strategies as explained earlier, and at the same time invest on a post-dividend declaration days and exit post-dividend declaration dates again if the investment horizon is less than 1 year. That will help you even save that 15% short-term gains tax over that 1 year period also. Thank you so much.